The Language of Candlesticks, written by Steve Nissan in Japanese Candlestick Charting Techniques. Imagine trying to understand a foreign language. It's a jumble of sounds until you learn the meaning behind the words. Candlestick charts are like that. They're a language telling stories about price movements in the market. Once you understand the language, you can see the story unfold before your eyes. This essay is your guide to understanding this fascinating language. A journey back in time. Let's embark on a fascinating exploration of the origins of one of the most essential tools in trading today. Candlestick charts weren't invented yesterday. They have a deep-rooted history that stretches back through the annals of time. These charts have a rich history dating back centuries to Japanese rice traders. These traders were pioneers in their own right, developing innovative methods to track and predict market movements. These traders developed a system for visualizing price fluctuations. They meticulously recorded the highs and lows, the opening and closing prices of rice, creating a visual representation of market sentiment. Imagine them, carefully tracking the price of rice, marking down the highs and lows of each trading session. Each mark on their scrolls was a piece of a larger puzzle, a glimpse into the market's behavior. These early charts evolved over time. They became more sophisticated, incorporating more data and providing deeper insights into market trends. Eventually, they made their way to the Western world. Western traders quickly saw the value in these charts and began to adopt and adapt them for their own markets. Today, candlestick charts are a staple for traders of all levels, from beginners to seasoned professionals. They are used to analyze everything from stocks to commodities, providing a visual representation of market psychology and helping traders make informed decisions. Anatomy of a candlestick. Understanding the anatomy of a candlestick is crucial for anyone looking to delve into the world of financial markets and trading. Before you can read the stories, you need to know the alphabet. Similarly, before you can interpret market movements, you need to understand the basic building blocks of a candlestick chart. Each candlestick is made up of a few key parts. These parts together tell a story about the price action within a specific time frame. There's the body, which is the thick part of the candlestick. The body represents the range between the opening and closing prices of that period. It tells you the opening and closing prices for that period. A green or white body indicates that the closing price was higher than the opening price, showing bullish sentiment. Conversely, a red or black body indicates a bearish sentiment, where the closing price was lower than the opening price. Then there are the wicks, the thin lines extending from the body. These are also known as shadows. These show you the highest and lowest prices reached during that time. The upper wick represents the highest price, while the lower wick shows the lowest price. By looking at the relationship between these parts, you begin to understand the sentiment of the market. The length and position of the wicks and body can indicate market volatility and potential reversals. Mastering this will give you a deeper insight into market psychology and help you make more informed trading decisions. Time, friend or foe. In the world of trading, time can be both an ally and an adversary. It all depends on how you use it. Candlestick charts can be viewed in different time frames, each offering unique insights into market behavior. Think of it like zooming in and out on a map. Zooming in gives you a detailed view, while zooming out provides a broader perspective. You might look at a daily chart to see the big picture, understanding the overall trend and market sentiment over a longer period. Or a 5-minute chart for a closer look at short-term movements, capturing the immediate fluctuations and opportunities. The time frame you choose depends on your trading style and objectives. Are you a long-term investor or a short-term trader? A long-term investor might focus on weekly or monthly charts, seeking to understand the broader market trends and make informed decisions over months or years. A day trader, on the other hand, might use 1-minute or 5-minute charts, constantly monitoring the market for quick trades and rapid gains. The key is to find the right balance and use time to your advantage. Candlestick whispers, basic patterns. Just like words form sentences, individual candlesticks form patterns. These patterns can give you clues about future price movements. For example, a long green candlestick often suggests strong buying pressure. A long red candlestick might indicate strong selling pressure. Learning these patterns is key to unlocking the predictive power of candlestick charts. Mastering the art. Practical tips. Candlestick charts are a powerful tool, but they're not a magic crystal ball. Use them alongside other indicators and always do your own research. Stay informed about market news and events. Remember, practice makes perfect. The more you study candlestick charts, the better you'll become at reading the stories they tell. This journey into the world of technical analysis is just beginning. Embrace the challenge and never stop learning.